today we are exploring a concept that plays a critical role in every modern economy, which is the politics of central banking. We also welcome our narrator for today's podcast session, which is Professor Michelle Sherry. We are truly honored by your willing to join us for today. So, Professor, without any further delay, let's begin the session, shall we?
Yeah, sure.
Alright. So most of us know central bank as institution that manage money and set interest rate. But behind this technical function lies a complex world of power, influence, and political tension. From rising price to loan repayment to economic stability, central banks shape decisions that affects all of us, often quietly and often more than we realize. So what do you think about this, Professor?
People think economic power sits firmly in the hand of elected leaders, but central banks like Bank Negara Malaysia, the Federal Reserve, and the European Central Bank make decisions that quietly shape our everyday life. For example, they control inflation, they set interest rates, and they stabilize financial system. And with power this significant, it's impossible to escape politics. In this episode, we unpack the politics of central banking, how it works, why independence matters, and what happens when political leaders push too far.
Oh, I see. So before we go deeper into politics, let's take a step back. What exactly is a central bank and why does it have so much power?
A central bank is more than just a financial institution. It is the guardian of nation money. It decides how much money circulates and control inflation. And it raises or lowers interest rate, which quietly influence whether people spend, borrow, or invest. Think of as a country economic heartbeat. When the central bank slow the beat by raising interest rate, borrowing becomes expensive. When it speed the beat by lowering the dose rate, money flow more freely. For example, in Malaysia, that role belongs to Negara Malaysia. In United States, it's the Federal Reserve. And in Europe, we can see it belongs to European Central Bank. But here the key, although they are supposed to stay independent, their decisions carry enormous political consequences. Like a small shift in interest rate can affect elections, business confidence, and even public anger.
Alright, we always hear this phrase, which is central bank independence. On paper, it sounds like simple, but in reality, is that really possible?
In theory, central bank independence means exactly this. The central bank makes a decision without interference from politicians. Economists argue that independence keeps inflation low, stabilize policy, and protect the economy from political manipulations. But the moment a central bank raises interest rate, the government feels the heat. Voters get angry, businesses complain, and politicians start asking, why did you do that now?
How politicians pressure central banks?
When rate rise, politicians don't stay silent. Sometimes the pressure is public itself. Sometimes it happens behind closed doors. A finance minister questioned a rate hike. Prime minister hinting that central bank is out of touch, or president openly attacking the governor. Even though independence exists on paper, a central bank mandate, its leadership, and its legal power are all granted by the government. So when political survival is state, leaders use speeches, media pressure, and even legal reform to influence monetary policy.
Oh, so independence exists, but it's fragile?
Very fragile. A single political comment can shake market, weaken the central bank's credibility, or pressure it to act in way to please voter, not to protect the economy. Ultimately, the central bank must be independent enough to protect the economy, but not so independent that it's become untouchable. In theory, independence prevents manipulations, In reality, every decision that has political consequences, and politicians react to those consequences.
And the tension only gets clearer when we are look at monetary policy itself, especially interest rate.
Yeah.
So right now we are moving to the politics behind monetary policy. Alright, okay, with this term. Okay, part. Okay, now we are continue for our part, which is, so now that we are understand why independence is complicated, let's talk about the tools that create all the political tension, which is interest rate, and then why do they matter so much politically?
Why they do matter? Interest rates are the central bank most powerful weapon. Raise them and the economy cools down. Lower them and economy heat up. But every moment create winners and losers.
So how about rate change affect different groups? Purpose, like household.
First, we see from aspect household. When rate rise, family with loan feel pressure first. Monthly payment grow and disposal income shrinks. For the second one, we see from a business aspect. For business, especially SMS, higher rate make borrowing expensive, expansion slow, and hiring stall. The third one is from government aspect. Government also borrow higher rates, raise the cost of managing national debt.
So every decision has ripple effects, and every ripple effect affects someone powerful enough to complain.
When we analyze interest rate decision, we can see why no policy choice is natural. Household, businesses, and government is face different pressure, and this shape how they interrupt central bank action. Monetary policy is designed for economic stability, but its consequences naturally spill into political drama.
Oh, and that's why central banks often find themselves at the center of political debates, even when they think they are simply doing their job. So now we are talking about case study, which is US, Turkey, and Malaysia. Now we move to the most interesting part, which is the case study from some country. Let's talk about what happened when politics interfere with monetary policy. So we will start with the United States first. Prof, today many people consider the United States as one of the best example of a political independent central bank. However, the conflict between Trump and the Federal Reserve shows the opposite. Could you explain what actually happened and why this situation is important for understanding the politics behind monetary policy?
Yeah, it's true. The US is often considered a model of politically independent central bank. However, in the case of President Trump, it highlights the fact that no central bank is truly free from political pressure, even if institution is strong. This is because Trump openly criticized and pressured the Federal Reserve to lower interest rate. This was one of Trump's political maneuvers, using interest rate as a tool. When interest rates are lowered, all type of loan become cheaper, and stock market rises, and the economy appear positive. All of this could enhance the administration's image ahead of election. The pressure had nothing to do with the actual economic condition of the country. Ultimately, the Federal Reserve maintained the interest rate to preserve its credibility and prevent uncontrolled inflation. This shows that political pressure still exists in central banks, even if they're said to be independent.
So it means that even though the Federal Reserve is independent, it is not immune to political pressure. However, because they have a strong institutional tradition, monetary policy does not change solely for short-term political gain, even if the president pressure for a change. So, how about Turkey forcing central bank issue, Doctor?
In Turkey, we can see how the government aggressively intervened by forcing the central bank to lower interest rate even though inflation are extremely high. The results were predictable. Inflation soared into around 80%, the lira collapsed, investor fled, and the citizen faced extreme living costs. This is clear example of what happened when politics dominates monetary policy because the central banks to lose all credibility.
So this show that when a central bank is controlled and used as a political tool, it indirectly leads to the collapse of the entire country.
Yeah, exactly.
Compared to other countries, Malaysia isn't as extreme as Turkey, right? So we have our own history, especially the forex issue in 1990.
Exactly, this issue show that political interference in financial institutions can undermine public trust and international reputation. The Bank Negara Forex loses raise serious question about governance and transparency, highlighting the risk when politics and central banking mix. After in 1997 ASEAN financial crisis, Malaysia implemented major reform to strengthen central bank governance, improve transparency, and restore the institution credibility.
This means that even though political influence still exists, Malaysia today has a higher level of professionalism and autonomy within Bank Negara. These reforms ensure that monetary policy focus more on economic stability and long-term growth rather than short-term political gains.
Exactly, Malaysia can show that while a central bank is never completely free from politics, strong institutions, clear governance, and lesson learned from past crises can help maintain credibility and protect the country economy.
Alright, so right now we are moved to interview segment, which is simulated question and answer. So now we move to the interview segment, Prof. My question is direct, really direct. Is there any central bank that is truly independent, is in the power?
Honestly, no central bank is 100% independent. These institutions are granted authority by the government in certain aspects, but the government still has the power to determine their mandates, law, and appointments. They are independent in their operations, but that independence is conditional. They have room to act, yet their framework is set by the government.
Alright, how about risk of intervention? If the government continuously interferes, what are the most obvious risks that can occur in a country?
The most obvious risks are inflation and economic instability. We can see this from political pressure to lower interest rates. Such action can undermine consumer confidence in the market because these decisions are not based on actual economic conditions. This can lead to currently higher borrowing costs and the central bank losing credibility.
Who is affected? From the situation we discussed earlier, who get affected the most? Which is the people or the government?
Directly, it's probably the people who are hit the hardest. When inflation rises, it automatically reduces purchasing power, prices go up, and wages may not enough. This can lead to significant economic hardship for the people. Even like small businesses struggle to survive due to uncertainty in interest rate. Eventually, the government itself is also affected because national borrowing become more expensive as the market loses confidence.
So, if too much independence doesn't work, and if politics dominate, it doesn't work either, what if is the most balanced formula according to you, bro?
In my opinion, the best model is a central bank that emphasizes operational autonomy but with democratic accountability. This means the government set a mandate while the central bank is free at using technical instrument. At the same time, the public can monitor its action through report, audit, and transparency. This strategy provides the most stable balance of power to ensure the central bank's effectiveness over the long term for the country.
Alright, right now we are moved to critical analysis. Now, let's move to the last session of our topic discussion, yeah? So for the first question, are central banks too powerful Prof, do you think central bank today are too powerful?
Yes, in many countries, central bank do hold significant power. They control interest rate, manage inflation, and oversee the flow of money in and out of economy. This power show how crucial the institution is in maintaining economic stability. But their major issue, central banks are not elected by the public. This raises an important question: are their decisions made in the interest of ordinary people, or they are made to satisfy the demand of financial market? Ordinary citizens want stable prices, fair wages, and affordable loans. Meanwhile, financial market want profit. Specific interest rate level and granted return on investment. When this interest clash, it creates what we call democratic deficit, a gap where institutions with enormous influence make decisions that affect millions but without direct democratic mandate.
Alright, so does giving too much independence to the central bank pose a threat to democracy?
Yes, this risk is real. If a central bank becomes too independent, major decisions are made by technocrats who are not elected by people. Economic policies may become less transparent and lean more toward financial market debt rather than public welfare. This can undermine the country's economic direction and credibility. But if government is too dominant, it can manipulate monetary policy before elections, trigger long-term inflations, and damage investor confidence. So both extremes are dangerous, but too much independence is harmful, and too much political control is equally problematic.
So the balance between government versus technocrats. So who should actually hold more power in the government or the central bank?
This create a classic dilemma. If technocrats hold too much power, their decision may become detached from the real struggle of ordinary people. But if too much power pulled back into the government, political manipulation can occur, turning monetary policy into tool of populism. The best approach is balanced partnership. The government was the overall objective. The central bank is given professional space to execute them. Proper check and balance are in place. All decisions remain transparent and accountable. This balance protects both economic stability and democratic legitimacy that create the foundation for long-term growth and resilience economy.
So with that, we come to the end of today's episode. We are seeing that the world of central banking isn't just about number, graph, or interest rate. It is deeply influenced by politics, and every decision has a direct impact on citizens, businesses, and the stability of the country. Too much political interference can destabilize the economy. Too much technocratic freedom can erode democracy. So the key is balance freedom with accountability. We would like to Prof for insight the guidance which made this episode possible. And then thank you to audience for joining us today episodes. So that's all from us. Thank you.